Dollar cost averaging versus investing a lump sum of cash. Which is better? That's a question a lot of people have had when it comes to investing, and it might be one that you have right now when it comes to your investing. Well, by the end of this video, we're gonna have a clear answer to that question. So let's dive in. In this video, we're gonna talk about the pros and cons of investing a lump sum of cash all at once. We're gonna talk about the pros and cons of dollar cost averaging. We're gonna discuss the difference between these two approaches in terms of returns or how much wealth either one of these can create and the difference between those two. And then of course, at the end, we're gonna talk about which one of these approaches is better for you and your investing and helping you reach your goals of financial freedom or building generational wealth for your family. So we're going to start off with lump sum investing. And so we're all on the same page. Lump sum investing is when you take a large sum of cash all at once and invest it right away. So you're investing a lump sum of cash all at once. So let's talk about the pros of lump sum investing. And there's all sorts, but I want to talk about the most important ones that I want you to walk away from this video. So the first one is it reduces the odds of missing some of the best days in the market. So you've probably heard tons of people, myself included, say it's not about timing the market, it's about time in the market. And you also hear often that it's important to not sit in too much cash because your money is losing out to inflation and you can be missing out on some really great returns in the market. So that point speaks to this in particular, where if you have a lump sum of cash and you invest it, you're giving your money the opportunity to participate in the growth of the market long term without missing some of those big days in the market. And as we'll talk about throughout this video, there are instances where investing a lump sum can outperform dollar cost averaging. Now, that's not the only reason to choose one or the other, but it is something to keep in mind, which we'll touch on as we go through this. But just quickly, talking about the concept of trying to time the market, this is something that you'll often see referenced when the market's kind of volatile, up and down, choppy, people are afraid, but the concept still applies if you're sitting on a lot of cash. So this is a study that's been run by several financial institutions. This is just one that's been done by JP Morgan Chase, but you can see the impact of $10,000 invested in the S&P 500 over a nearly 20-year time window. If you didn't miss any of the best days in the market because you were fully invested, meaning you weren't just sitting in cash, over this time period, that $10,000 grew to $65,453. Or in other words, you had an average 9.85% return, which is pretty standard for the market. However, if you missed just 10 of the best days over this 20-year time period, instead of having that $65,000, you only ended up with just north of $32,000. Again, just 10 days over a period of 2 decades. Not a ton of days in the grand scheme of things. And in this case, you'll only had an average 6.10% return. And as you can see, the more the best days in the market that you miss, the bigger the impact it was on your returns and your ending amount of wealth. So the point here is, if you have cash, it's important to have it invested so you're not missing out on some of these really big up days in the market, which can make a big difference in the long run. So those are the high-level pros. Let's move over to the cons, because there's definitely cons to lump sum investing. The biggest one of those being something that's called timing risk, which in plain English is just the risk of you investing at the worst possible time. In other words, investing at the top, and then all of a sudden you see that money get cut by 10, in some cases 20%, which is really common, especially if we're talking about investing in assets like the stock market, which does not go up in a straight line. And if you've been investing for some time now, hopefully you know that. And of course, because of that, this type of approach can feel much more stressful than dollar cost averaging, because you're putting all your money, all your chips on the table all at once. And now you're subject to seeing that go up or down depending on what the market does. And some people really struggle with this. You might struggle with this, and that's okay. That's a part of investing, and it is something that's inherent to this style of investing if you're investing a lot of cash all at once. So let me give you a quick example of what this can look like. And actually, I'm going to share a quick personal story. So this is going back to 2018 when I was still in the wealth management industry as a financial advisor before moving on and starting my own thing. I had a buddy that was an advisor as well, and he was onboarding a client that he had been working with for some time to bring him on as a client. And I remember it was the beginning of the year and the market was kind of up and down, and he got the client invested. So he was sitting on a lot of cash and finally got him into the market. And I remember during that period of time, the market took a massive, massive hit. relatively speaking. And the client was freaking out because remember, he had all this money that was in cash where he felt safe with it. And then all of a sudden, this advisor encourages him to get it invested, which in the grand scheme of things was the right thing to do. However, my buddy didn't do the best job of educating the client on the fact that, there's timing risk involved with this decision. And the client was freaking out and he wanted to pull out of the market and go to cash and lock in those losses and shoot himself in the foot. So that's just one example. There's so many other examples in history. I just want to share a personal example with you from something I've seen in my career personally. And this is something that I definitely walk through with all my clients and students when we're talking about investing lump sums of cash, because it is one of the biggest risks. So now let's shift gears and move over to the other side of the table, or dollar cost averaging, or DCA for short. Let's talk about the pros of dollar cost averaging. So when it comes to dollar cost averaging, bar none, this is one of the best ways to grow your wealth from scratch. The fact is, most people don't just have six figures in cash or more laying around, and that's okay. You don't necessarily need to have $100,000 or more sitting around in cash in order for you to start investing. If anything, one of the best habits that you can get into if you are building your wealth from scratch is to treat your investments like a bill. In other words, automate your investing and set a certain amount aside into your investments every single month or bi-weekly or weekly, however often you want to set it up. And that by far is one of the best ways to start growing your wealth from scratch. Plenty of people have hit the $1 million mark and beyond starting from zero. And again, it's one of the most practical ways to go about building your wealth long term. And if you are lucky and you do this correctly, there are some instances where dollar cost averaging can actually help you get more shares at a lower purchase price on average. And that's what I want to talk to you about next. So this is an oversimplified example, and I want to stress it doesn't always work this way, but this is just to show you how this can potentially be beneficial, especially if the market's kind of up and down. So we have two different scenarios. In one scenario, you invest $6,000 all at once, and in the other scenario, you dollar cost average. And again, dollar cost averaging, meaning you're just investing a fixed amount of money on a fixed schedule, so a certain amount of money per month, for example. So in scenario one, you invest the $6,000 all at once, and you secure 600 shares at a price of $10 per share, because that's what the investment was trading at this point in time. Where in scenario two, you spread out that $6,000. In other words, you invest in $1,000 increments over a 6-month time window. In scenario two, you'll see that represents the blue dots here. There are some scenarios where you buy more shares because the investment was down in price. And there's some scenarios where you end up with less shares because the investment was up in price. But in this scenario, where remember the first scenario, you invested the $6,000 all at once as a lump sum, you got 600 shares at $10 per share. In scenario two, where you dollar cost average, you ended up with 678 shares. Again, there were some scenarios where you were able to pick up more shares than others, and you were also able to secure those shares at a lower purchase price on average of $8.85. So this is a simple example. Again, it doesn't always work this way, but this is a case for how dollar cost averaging can be beneficial, especially if we're seeing some up and down markets. Okay, so now let's move on to the cons of dollar cost averaging. One of the biggest ones being the fact that it can underperform lump sum investings, especially in a rising market. And we'll talk about that here with some more numbers and examples. And then secondly, like we talked about in the lump sum investing section, if you are sitting a lot of cash and you're not just building your wealth from scratch, you're possibly setting yourself up to miss out on some of those biggest days in the market, which, as we've talked about, can be really detrimental to your long-term success. So now let's talk about how choosing one or the other can impact your returns or the amount of wealth that you're able to build. So what I want to do here is I want to show you an example using a tool called Portfolio Visualizer. It's a solid free investing resource. You can check it out after the video. It's something I share with a lot of clients and students to help them understand how to analyze their investments. But in this scenario, we're going to look at two different portfolios. Portfolio one, we have a lump sum that we're investing all at once into the S&P 500. We're investing $100,000 all at once, and we're letting that grow over a 10-year time frame. In portfolio two, instead of investing $100,000 all at once, we're breaking that up, or we're dollar cost averaging it, and we're investing in $10,000 increments over that 10-year time frame. So we're still investing the same amount of money, but in scenario one, we're investing it all at once, whereas in scenario two, we are dollar cost averaging or breaking it up over a 10-year time frame, that 10-year time frame being from 2014 to, through 2024. And again, in both scenarios, we're investing in the same thing, something as simple as like an S&P 500 index fund. So what are the results? Again, keep in mind, over this 10-year time frame, the market has done very well. So it's been, for the most part, a rising market. There's been some rough spots for sure, but this is going to really tie into what we'll talk about here in 1 second. So as you can see, the results here from the Portfolio Visualizer website, Portfolio 1 ended up with an ending value of $331,453. That was a lump sum example, whereas Portfolio 2 ended up with $204,416. So again, in both scenarios, you were more than positive and you did very, very well. But this goes to show you that sometimes, especially in a rising market and a consistently rising market, there are instances where lump sum investing can outperform dollar cost averaging. And there's actually tons of study on this subject in particular. Vanguard has a lot of great literature on it if you want to check it out after this video. I just wanted to show you a quick example that you're welcome to do on your own after this video is published, so you can see how the decision to invest a lump sum or dollar cost average can potentially impact returns. So that leads us to the question, which one of these two is better? We just saw that outperformance can occur through lump sum investing. So does that mean that lump sum investing is better overall? Not necessarily, right? There's definitely pros and cons of both, as we talked about, but we need to think a little bit deeper beyond just the potential returns. So let's talk about when lump sum investing can be better. This typically makes sense if you already have a large sum of cash. Maybe it was from a large bonus that you received at work. Maybe it was from shares that you cashed out from equity awards at work. Maybe you received a large inheritance. For whatever reason, you have a large sum of cash and you can do something with it. In these types of instances, it can be a good opportunity to get it invested and get it put to work in the market all at once. A key thing to keep in mind, though, is if you are investing through either lump sum or dollar cost averaging, of course, you want to be investing for the long run, but because of that timing risk that we talked about earlier in the video, it's especially important that you have a very long-term mindset when it comes to your investing if you're investing in lump sum, because if you're investing in stocks and if you're following an aggressive approach, you have to be ready for that money to go down before it goes up. And a lot of people miss out on that, and that's a big mistake. And you'll also have a long-term strategy that you understand that you're putting your money into that you can stick to no matter what the market does. If it goes up or down or sideways, you're willing to commit to that strategy and you're willing to ride it out. If you don't do that, you're setting yourself up for failure and you're setting yourself up to make a lot of emotional mistakes with a large sum of money, which is, of course, what we want to avoid. So when is dollar cost averaging better? Again, dollar cost averaging is a great way to build your wealth from scratch. Most people don't have 6 figures or more of cash sitting around, and you don't necessarily have to wait until you have 6 figures of cash sitting around to start investing. You can start investing right now. You can incorporate into your monthly budget. You can make a cash flow plan and figure out how much I can afford to invest and pay myself first to start growing my wealth on autopilot. It's also beneficial when you're worried, especially in a choppy market, especially when there's a lot of volatility, there's a lot of fear, and you're worried about the phrase is catching a falling knife, right? When you're investing in a lot of cash and the market just drops, like we talked about a second ago, dollar cost averaging can be beneficial here, especially when the market's consistently going down. That's considered averaging down, and there's pros and cons to that strategy, which we're not going to talk about too much in this video. But if you're investing in something that's solid long-term, that has a great chance of rebounding, that is a potential scenario where dollar cost averaging can be beneficial. And again, you have a clear plan to get the cash invested on a clear timeline. So if you are on the other side of the equation where you already have a lot of cash and you're nervous about investing all at once, again, that's perfectly normal. The main thing is you come up with a disciplined timeline to get that cash to work. So for example, if you have $100,000 in cash and you don't necessarily want to invest it all at once, you can say, all right, I'm going to set a goal to have this $100,000 invested by the end of the year, for example, or within the next 6 months or something of that nature. That way, you're not just consistently sitting on cash and missing out on potential opportunities for growth in the market. And again, that's in the scenario if you already have a good amount of cash on the sidelines, but you're worried about investing in it all at once because you know yourself as an investor and you feel like you're going to panic and make mistakes. It's much better to go down this route where you're dollar cost averaging into the market versus you investing in the lump sum and shooting yourself in the foot if you don't have that existing experience and discipline when it comes to investing. So Very important to keep in mind. So what are the main takeaways of this video? We've talked about a lot. We've talked about the pros and cons. We've talked about performance. We've talked about all sorts of things. Now we need to talk about, well, what's better for you. And before that, I think it's important to say the fact that you can be successful doing one or the other. Yes, we've talked about how investing lump sum can potentially outperform, but performance isn't everything. And I know that sounds backwards because the point of investing is to make money, and of course it is. But it's also about putting together a strategy that you can trust and you can stick to, and that you won't let yourself fall into the trap of panic selling or making emotional decisions, because investing is a long game. It's a game of managing your emotions, and it's a game of avoiding critical mistakes, which can be elevated when you're investing a large amount of cash all at once. So again, you can be successful investing a lump sum of cash all at once. You can be successful dollar cost averaging. You can be successful doing a combination of those two things. It really comes down to what's in your best interest. What do you understand the most? What are your financial goals? And what is the approach that's going to help you best reach that goal without making emotional decisions along the way? So next steps from here are, if you're watching this video, if you found this helpful and you're thinking about investing, or maybe you've been investing for some time now, and you have a big goal, whether it's financial freedom for yourself, generational wealth for your family, or any combination of those two things, but you're not really sure if you're on track, or you're not sure how to get started, or you're not sure if you're doing enough, or you just simply need some guidance. You want to make sure that you have a plan, you know exactly what you're doing, and you're on track to reaching those goals with minimal stress so you can live your best life financially. Next steps from here are simple. In the description to this video, you're going to see a link that you can use to schedule a quick free one-on-one consultation with myself. That's an opportunity for us to sit down, help me better understand your situation, help me better understand your goals and the things that you're doing right now financially, so I can point you in the right direction. So again, the link to that is going to be in the description to this video. You can click that to schedule that time with me. But that's a quick rundown on the differences between lump sum investing and dollar cost averaging. Again, there's all sorts of literature you can look up after this video. Again, Vanguard has a lot of really great resources on it. I just wanted to touch on the key points and make this as digestible as possible. But if you found this video helpful, make sure you give it a thumbs up. If you have any questions on anything that we talked about in this video, feel free to drop them in the comments and I'll answer as many of them as I can. And again, if you need help getting on track with your investing and reaching your goals, all you have to do is use that link in the description to schedule a quick free one-on-one consultation with myself. So just want to take a second to say thanks for watching the video. Again, I hope you have found it helpful, and I will see you in the next one.